Good morning, everyone. This is Morgan Hill, CEO and founder of Hill and Hill Financial. It's currently Friday, August 22nd, 2025 at about 8:30 Eastern Time. Cannot believe that summer is basically over and we're moving into fall, Labor Day. Hopefully everyone's doing well. And I wanted to kind of give you a state of the markets, have a conversation with you this morning because there are really three things that I want to talk about. Here's the first. Boy, there have been a lot of headlines as we've been watching the news. We've got geopolitical issues, trying to negotiate truces with wars around the world. We've got tariffs. One week things are looking good, the next we just don't know. Interest rates, is the Fed going to keep them steady? Is it going to drop? What's going to happen with this meeting in Jackson Hole, Wyoming? What's going on with unemployment? What's going on with the general state of the economy? And it can be very disconcerting when you begin to take a look at that. And so, as we're going to unpack this today, what I wanted to just do is just give a perspective. I'm not here to predict anything. Obviously, I've joked with people when I was 9 years old, I had a crazy eight. I don't know if anybody's old enough to remember those. You'd shake it up and it would try to tell you what was going to happen on the bottom. And it broke when I was about 12. And so my ability to foresee or foretell ended in 1972. So as we talk through a couple of these slides today, it's one, just to say a lot of this unrest and a lot of these things bouncing back and forth have created a lot of uncertainty with folks. What do we do? One of the final things that I'll share is, we have seen certain segments of the market, these magnificent seven, AI and semiconductors and those things really driving it. And so it's very easy for folks to lose focus to try to chase after the next hot thing, or what I call sometimes the next shiny nickel. And so hopefully today we're going to visit a little bit, talk about the history of the market, and then really just reinforce strategically how we should be approaching retirement and really understanding the different types of risk and how we can either manage them more effectively and in some cases avoid them completely. As everyone can see this slide, stock market drawdown since 1928. This is literally the history of the last 100 years of the market. And we have periods of time in which they're bears and period of time in which you see bull markets. Just kind of a quick side note, people have asked me, where did they come up with that name, bulls and bears? Well, it's based on my understanding of zoology. When bears attack, they swipe down. When bulls attack, they gore up. So bull markets are up, bear markets is down to where they get the name. But what we'll see in this chart of the last 100 years, boy, have we had a lot of different events taking place between, wars and economic expansion and oil embargoes. We've had all sorts of things in the last 100 years. But we see that these periods of bull and periods of bear, we move up and down, but what you see is the general slope of the line. I learned that in 10th grade geometry, is the slope of the line. It can have all sorts of ups and downs in between, but the general slope is up. So people have asked me, it's like, over time, Morgan, does the market go up? And I said, the answer is yes. Look at the chart. But the issue is when we're moving towards retirement, we don't have sometimes 50 or 60 years to navigate. Many of us retire in this window of time. And so when we look at kind of the ups and the downs, it's not that it won't recover, it's where are we in this cycle? And the other is what do we need to do with the money that we have? See, back in the 20th century, it was all about, I had pensions, I had Social Security. And so the money that I set aside, I didn't necessarily have to live on. Well, now as we move into the 21st century, I need this 401k, I need this IRA to live on. And so going through these ups and downs, it's not that it won't get better. It's just, where am I in this mix and what do I need to use the money for? That can be very challenging and very difficult. And so, one, this is meant to say, okay, over time, it does look good. But the final thing that we'll talk about is how do we now retire into volatility and manage and navigate through all of these cyclical ups and downs, periods of bulls and periods of bears, and how can you do it with a level of confidence that you know that you've got a plan that works. This final section I want to talk about is things that we've talked about before, but I think it bears repeating. As we have all these headlines now that can create this volatility and uncertainty, over time it does work out, but now it's about how do I navigate in it. I've talked a lot about these worlds where money can live, these three worlds of money. A little bit of a history lesson. There's a guy named Harry Markowitz that most people go, I have no idea who this guy is. but boy, we live in the shadow of what he created. He was born in 1927, and at the tender age of 25 in 1952, he came up with what's called modern portfolio theory. He said this: the rational investor, and I think we can look at each other and go, we're rational. The rational investor should seek to increase gains while limiting risk. In order to do that, you should diversify, there we get that word, diversify amongst non-correlative assets. That's a fancy way of saying we should invest in things that move differently, that act differently, and we should balance it with bonds and cash. Well, he and his colleagues from the University of Chicago went on to win the Nobel Prize in economics in 1990 for that theorem. And so, really, as you take a look at worlds where money can live, one world that we look at is the world that's neither stable nor guaranteed. It's not bad. It's really designed for growth, and things can go up and down. And if I diversify broadly enough and wait long enough, it's going to be up. Remember that slope of the line we just talked about? And then you should balance it with bonds and cash. Well, that's fine as you would look to accumulate, but those were the only two worlds of Dr. Markowitz. Non-stable, non-guaranteed, but it's going to be good over time. And then you move it to stable and guaranteed. And historically, banks and credit unions and U.S. treasuries just haven't paid enough to keep up. And so we've expanded those two worlds to add more. The third world is a world that if you don't have a pension and you need one, you can create other types of investments that, although the returns are not stable, I don't know what I'm going to get every year, whatever I get, I keep. And those are some different types of annuities. And again, I don't love them, I don't hate them. They're just a kind of tool. Well, that's the third world. Well, then there are these little satellite worlds where you can have investments that are stable. They're not guaranteed, but they're stable. Different types of dividends, different types of bonds and notes to create that stable return that you might need during your retirement years. And so instead of just having these two worlds, I don't think Dr. Markowitz was wrong. I just think the 21st century has created more need than what we saw in the 20th century. Yet many of us are still living in the shadow and investing in the shadow of Dr. Markowitz, and things have changed. And one of the reasons things have changed is about the nature of risk. See, a lot of times when we talk about risk, we just look at the broad brush, right? I'm conservative. I'm moderate. I'm aggressive. I think the conversation of risk needs to go a little deeper, needs an extreme makeover, if you will, if we talk about building a better retirement. There are different types of risk that we need to really be thoughtful of to either manage more effectively or avoid completely. One, is there market risk? Do I think the market's going to tank? Is there credit risk? Do I think this company is going to go out of business? Volatility risk is the big one. Is this investment subject to bouncing around based on current market conditions? Is there duration risk? How long am I in this thing? Liquidity risk. Hey, I need that check next month. Well, you can't get it until 2 years from now. And then finally, interest rate inflation. One of the biggest fears that I hear from people is, Morgan, I don't want to run out of money, not just for me and my spouse, but also if I pass away, that they live on and they can have money to take care of themselves. And so as we look at these different kinds of risk, we also look at within the context of what's the purpose of the money. Is it for income, which if we're building, I'm looking at that as roofs, rooms, floors, and doors? Or is it for the growth side of things, which to me are fire pits, pergolas, and pools? You know, it's the more entertaining side. I'm not trying to live on it. And so as we move forward, folks, a lot of headlines. We want to stay focused on our risk profiles and what our objectives are. Know that over time, again, historically, the market has gone up. But we think that using those three worlds of money, looking at where money can live among worlds, not just within a world, and have a better conversation about risk can help us navigate through and really give us that confidence that we can walk comfortably in this thing called retirement that we've been working to not just get to, but to navigate successfully through. So hopefully this has been helpful as kind of a quick State of the Union update, state of the markets. As always, if you have any questions, 800-887-9647. Thanks again.